So obviously we're going to go ahead and get started then. Thanks for those of you who are attending here in person and those of you attending on the Zoom call. What I wanted to cover today, and obviously what we're here to talk about, is appraisals. A lot of you guys are familiar with appraisals and kind of how appraisals work. Some of you may not be, so we'll go into some of the basics of it. But what I really want to talk about is kind of how lenders use appraisals and where problems can come up in the loan process that affect listing agents, buyer's agents, things like that. My name is Garrett Helminski. I'm a senior vice president here at Peoples. I've been in the mortgage industry for a little over 20 years. I've been at Peoples since 2002. So I've been involved in mortgage banking for a lot of ups and a lot of downs. My background is operations. So I am the underwriter of record on about 8,000 mortgage loans. And so I've seen a lot here at Peoples. Besides all of my other duties, I am ultimately in charge of underwriting and our appraisal process. I have been for years. I'm on the Mortgage Bankers Association Residential Loan Production Committee. So I'm involved kind of at the national level with all of the things that go along with mortgage banking. I've been heavily involved with the appraisal process. I created the process here at Peoples to be compliant with all the regulations that we have, created our appraisal panel. I've also spent a lot of time doing presentations like this with the real estate community. I've been doing presentations really with the real estate community probably for close to 10 years now. I definitely am a big believer in the more information we can share between the lender side and the agent side, the better we can all be at serving our mutual clients. And one of the things that I've noticed over those years is there's a lot of misinformation or information that's not shared between lenders and agents, especially when it comes to the appraisal process and what we look at and why we look at those things. So I like talking about this. Because I think, this is one of those things, especially in a market like this, where the appraisal can really have a big impact on the closing and getting everybody into that new home. So some things that are definitely interesting for those of you who don't know, there are not new appraisers. We are running out of appraisers. Basically, if you look at data from the Appraisal Institute, between 2014 and 2018, we lost 10% of the appraisers in the country. That is basically because of their age. So we are not getting new appraisers because of the requirements that it takes now to become an appraiser. You basically have to have 60 college credits, you have to apprentice with another appraiser for a certain amount of time. And so we are not seeing new appraisers come into the industry. The barrier to entry was higher. They make less money now generally than they used to. So the average age of the appraisers in the country is such that they're starting to age out and we are seeing fewer appraisers. That 10% reduction number comes from the Appraisal Institute, which is kind of one of the main appraisal groups here in the nation. You also have some data from Freddie Mac that talks about the difference between 2012 and 2000. In 2020, we did about 50% more appraisals than we did in 2012, and that's with fewer appraisers. So we're seeing a reduction in appraisers every year, but we're doing more and more appraisals. So for those of you that are listing agents and buyers agents, obviously you're probably seeing deals where it's taking forever to get the appraisal scheduled. It's taking forever for the appraiser to get out there. We here at Peoples lend in 38 states. There's some states where it's terrible, where it's 3, 4, 5, 6 weeks to get an appraisal because there's just not a big amount of appraisers. Yes.
Are they trying to do something to help get more appraisers in?
Yeah, so we'll cover some of that today, what people are talking about doing. To give you another example, 2017, this is kind of the last year we have real good numbers. There was basically 6 million homes sold. In 2017, 6 million homes sold. There was about 2 million licensed real estate agents. There was 80,000 appraisers. So, the last good numbers we have are from 2017. There was basically one appraiser for every 25 real estate agents. So you can see, again, we have those shortage issues. Again, there's a lot of different reasons for that. One of the things that is going on is the different groups are trying to look at solutions for that. So as you mentioned, what is the solutions? There are things that they're looking at right now. Fannie Mae and Freddie Mac through the FHFA they have an initiative to look at the future of appraising and what we can do to solve this backlog, use technology, things like that. I was part of a group that was providing recommendations to Fannie Mae and Freddie Mac about what we can do. A lot of the talk is things that are called hybrid appraisals, where you have one person be at the home, do the measurements, take the pictures, and then using different technology solutions, the appraisal gets completed kind of that way. One of the solutions I personally am in favor of is you can use technology to complete the appraisal, but you get things like measurements and pictures from the listing agent. Listing agents are already licensed. They're already in the home most of the time. They're a reliable source of good information. That's not just my recommendation. There's other people in the industry that believe you can maybe have a higher level of certification or licensing for listing agents so that they're held to a certain standard for doing those measurements, taking the pictures, and then the rest can be done with technology. So they're looking at a lot of different solutions like that to figure out what is the best way to get reliable data into the system. Going back to the days of getting appraisers into the business is probably not going to happen. So they're looking at solutions utilizing different technology solutions, and then kind of separating out maybe the pieces of measuring the house, taking pictures of the house from the actual analysis of the value. So it'll be interesting to see what comes out of that. And,
I'd like to see the pushback from the listing agents.
Well, I think a lot of listing agents probably would want that because it would make the process go smoother. Buyers agents, maybe not so much, but again, what some of the talk that is going on right now with the RFI that Fannie and Freddie have about the future of appraisals is, can you just rely on one group to take the pictures and do the measurements, but then a different group or technology actually does the analysis? So it wouldn't be that the agent would be providing the value, they would just be providing the data. And, again, listing agents are already licensed. So, it's the same way appraisers are licensed. So that's one solution. The hybrid appraisal is a very popular solution. In our industry, we have had we've seen a lot of things that's with appraisal waivers, which is where we run the loan through one of the automated underwriting systems, and it comes back and tells us that based on this property, we don't need to get an appraisal. Some buyers like that, some buyers don't. So that's something to keep in mind. Of course, the whole thing about an appraisal is, what is an appraisal? What does it do? Does it determine the value of the home? What we have to remember is that from a lender's point of view, the appraisal determines the value of the collateral we're making the loan on. That is not the same thing as what the home is worth. It is to determine the value of the collateral. So I know that kind of sounds like the same thing, but it's a little bit different. It's one of the reasons why if you look at an appraisal report, the client on the appraisal report is the lender, because the appraisal is to protect us as the lender to make sure that we have collateral that is sufficient for the loan. It's one of the reasons why we see the disconnect that we see in a market like this, where we have balance of demand and supply, what we call a seller's market, right? So if you think about an appraisal looks backwards in time. The appraiser finds sales that are similar to the property that have already sold, and that is helping to determine a baseline value. Of course, what a listing agent is doing, right? Somebody comes to you, they want to sell their house. You're trying to determine what someone will pay for that home in the future. So when you have a market like this, that's where you always have that disconnect between what the appraisal is and the sales price. It's because The appraisal is looking backwards in time to determine a baseline value for the collateral, but a listing agent is trying to figure out what you can sell the home for in the future. That future might be next weekend. And you guys know in this market, I mean, the price this weekend and the price next weekend could be 10% different. But the appraisal is looking backwards in time because, again, it's not trying to determine the value of the home. It's trying to make sure the collateral is stable for us as the lender. That became even more important after the Great Recession in 2008, right? Lenders got stuck with a lot of properties that ended up being worth less than what the loan was. And so things were put in place to make sure that the value of our collateral was good. So one thing to keep in mind again is, the appraisal is a determination of the value of the collateral. It isn't the sales price of the house. It's not what the home is worth. We do have sometimes funny situations with borrowers who will get their loan with us. They get their appraisal. The appraisal comes in at the sales price and they're not happy because they wanted the appraisal to come in over the sales price because they want to make sure they're getting a good deal. But that isn't what the appraisal does. So I often talk to those borrowers and explain to them, this doesn't mean you're getting a good deal or not a good deal. The appraisal is determining the value for us as the lender. It doesn't matter to me as a lender if the appraisal comes in over the sales price or not, because I'm basing everything off of that sales price. So there's no incentive for the appraisal to come in higher. Again, a lot of buyers want that because they want to see if they're getting a good deal or not. But for us, we're only concerned if the appraisal comes in below the sales price, which in the seller's market is very common. We are seeing that in a huge amount of markets. We do a lot with CoreLogic. They're one of the largest appraisal and value technology vendors in the country. A lot of you guys have heard of CoreLogic. They provide information on a monthly basis out to the industry. The NAR gets data from them. The MBA and our industry gets data from CoreLogic. CoreLogic says there's markets in the country right now where 40% of the appraisals are coming in below the sales price. We are seeing that in certain markets as well.
Brennan had wanted to see if you would touch on the appraisal strategy that would help people in that situation.
So we will get to stuff like that. So a little bit about what is going on in the market, just so kind of everybody understands how we got to where we are. We, as an industry, so this is all mortgage companies, whether it's People's Mortgage or the company that you ride a stagecoach to, or the company that you take a rocket to, we all do the same things. And one of those things is we have to upload our appraisals to this thing called the Uniform Collateral Data Portal. And that has been in effect since March of 2012. So all of these Fannie Mae and Freddie Mac appraisals get uploaded to this portal, and they use that to aggregate data on the different markets on what the appraisal is, quality appraisal, not a quality appraisal. When we get loans that don't require an appraisal, the data comes from this database. It's a super secret database that Fannie Mae and Freddie Mac control. They don't allow us to know their algorithms, but they have so many appraisals in there because we have uploaded as an industry every conventional appraisal to that database since 2012. So right now, Fannie and Freddie say their database covers 97% of the properties in the US. And this has the largest impact on appraisals is this. This is a huge, huge change. My personal feelings about this are not so great. I have a lot of experience. I've been doing this a long time. I feel like my knowledge is better than the computer's knowledge. They, of course, do not agree with me. Then in the first quarter of 2015, so more than 6 years ago now, Fannie Mae rolled out this thing called Collateral Underwriter, which I'll show you guys some screenshots of. It's a tool that tells us if the appraisal is good or not. So when I got into the industry, it used to be my judgment, my experience, my training that would tell me if the appraisal was good or not. Now it's a computer, and every lender is dealing with this. Freddie Mac rolled that out in Q4 of 2016. It scores every appraisal from 1 to 5, and 1 being great, 5 being not great. And then some get a 999, which means there's not enough information to make a determination. That's very rare now because there are so many appraisals in there. So for those of you who have been in the industry as long as me, you remember a time when real estate agents and loan officers could pick the appraiser. So I call those the good old days. It made my life a lot easier because if the appraisal came in low, then I could say to the loan officer or the real estate agent, well, you pick the appraiser. Yeah. And so now we're not allowed to do that. That changed in May of 2009. There was a lawsuit between the Attorney General of the state of New York and Fannie Mae and Freddie Mac about appraisal independence. That resulted in this thing called the Home Value Code of Conduct, the HVCC, which went into place in May of 2009. That is when agents and loan officers were no longer able to pick or influence the appraisal for a specific loan. And that's how we got to all of this. For those of you who are interested, the Attorney General of the state of New York at the time was Andrew Cuomo. That is, of course, now somebody that's in the news for different reasons. So if you want to know why we got to where we got, it started there. It started with a lawsuit between the state of New York and Fannie Mae and Freddie Mac about appraisal independence. And so from there, we got the Home Value Code of Conduct, we got the FHA Air Appraisal Independence Regulations, and then we moved more and more to this technology and how the technology impacts appraisals and us as a lender. So when we run a loan through, we get all these messages that tells us about the appraisal. It will say this appraiser adjusted this line item differently than other appraisals in the database. It will say this appraiser says comp 1 has C2 condition, but other appraisers have said C4 condition. It is comparing the appraisal to every other appraisal it has in the database, other properties in the neighborhood, past appraisals on the same house. So it is looking through all of that. It pulls 20 comps. So this system provides 20 comps that it compares to the comps that the appraiser used. This is one of my frustrations with Fannie Mae personally, is like, you guys, the system already has comps in mind. Like, why don't you just give those to us ahead of time and then we can give them to the agents and make the whole thing smoother, but it's all super secret. We're not supposed to share any of this information directly with the appraisers. It's a proprietary system that's between Fannie Mae and Freddie Mac and the lender. One of the interesting things, though, is that as of December 2016 and April of 2017, appraisals that get a certain score, they provide what's called rep and warrant relief to us as the lender, which means when we deliver the loan to Fannie Mae and Freddie Mac, we are not responsible for the quality of the appraisal. Rep and warrant relief is very valuable to us as a lender because it means we don't have any liability for that part of the loan. And this is also influencing how lenders look at appraisals, and we'll go into a little bit more detail on this. This is one of the reasons why it's so hard to get appraisals changed, bad appraisals thrown out, values changed, because lenders have to protect themselves. We also have to deal with the consequences of quality control reviews and things like that. So one thing to keep in mind throughout this discussion is I'm talking about Fannie Mae, Freddie Mac, FHA, VA, kind of their general guidelines. We as a lender, we retain most of our loans, so we're dealing directly with those agencies. Sometimes you guys as listing agents or buyer's agents, you may be dealing with a lender that has overlays that may have more restrictions. I'm just talking about the general stuff right now, not lender specific things. So I definitely know you don't control the lender in every transaction. Some lenders have more restrictive guidelines, but what we're talking about today is the actual agency stuff. So when we talk about rep and warrant relief, again, this is what we're talking about, where this means as a so this is important for lenders like us who were around in 2008 when the market fell apart, because we were required to repurchase loans from Fannie, from Freddie, from FHA if the loan went down and they did a quality control review and they said the appraisal wasn't good, we were then on the hook for the loss as a lender, as were all lenders. So this new thing, again, I told you they score from 1 to 5. If the score is 2.5 or better, I am no longer on the hook for the value of that property, even if the market crashes. So lenders want to see a score of 2.5 or better, regardless of the value, because that loan is more valuable to me as a lender because I have less risk. So none of this has anything to do with the borrower or the purchase contractor or the agents, right? It's all about risk mitigation. And so this is an important thing for lenders. This is one of the things we look at. So this is kind of an example of something that we get. This is kind of a screenshot of what part of what we get. It's a lot of data that comes through this automated system, but you can see here's this home. It scored a 4, which is not great. And it says it has a heightened risk of overvaluation. So this particular appraisal came in under the sales price. And so the agents want us to reconsider the value. Where I am as a lender now is I have to, if I reconsider the value and I have to explain in a quality control review why this appraisal said the value is already too high. Why did I then reconsider for an even higher value? So this system sees all of that information. This is one of the reasons why it's so hard for lenders to overturn or argue an appraisal, because this information is already in there. So this is an example of one of the things that we could see. So we're always looking for the score. We want it to be 2.5 or better. This particular one was a 4. So when you have higher scores, every lender is a little bit different. They do different levels of quality control review on those higher scores. There are some lenders that will not take appraisals if they're a score of 4 or 5. So sometimes you may be involved in a transaction where you got an appraisal and then the lender says we need another appraisal. Sometimes the most common reason for that is it had a bad score and that lender doesn't accept higher scores. So we are allowed as a lender to accept higher scores. We just have to have justification for why we still believe it's a quality appraisal, even though the score is not good. So here's an example of what we get. These are the 20 comps. So this particular appraisal, the blue houses are the comps that the appraiser used. And then the gold houses are the comps that the computer system believes are the 20 best comps for this property. So we see this after the appraisal is done. We're not allowed to see this before the appraisal. The system is set so we can only see it after the fact. And so again, this is one of those scenarios where when somebody wants to do a reconsideration of value or argue the comps, we go here and if I see that the appraiser has already used the top comps that the model picked, if I now allow different comps to be used to give me a different appraised value, now I have to justify that. And Fannie Mae and Freddie Mac don't believe that anybody is smarter than the computer. Me, the listing agent, the buyer's agent, they say the computer knows best. The appraiser used the 4 comps. The incentive, of course, is to make appraisals more generic, right? The more generic they are, the higher the score tends to be. So the appraisers don't have incentive to do more research to try to find comps that are maybe better. They just try to find the comps that are most likely to get a good score, right? And so this is kind of what we see. It shows all the adjustments. It's pulling all of these comps, not from MLS, but from other appraisals that are in the system that other lenders have uploaded. So it's looking at completed appraisals and determining what the value should be. And then again, we see this on all of the appraisals. The blue houses are the appraiser's comps, the gold houses are the comps that the model picked. So we as a lender want to see this pattern here where the 4 comps are the top 4. If we have an appraisal where all the blue houses are down here and none of the top comps were used, then we have a concern as a lender. that maybe the appraiser didn't use the appropriate comps. So the problem with this, of course, is unique properties are very hard to make this work. Properties where borrowers have, or where the homeowner has upgraded the home. Properties where since the last appraisal they put in a pool or they added an addition. Some of those things don't accurately reflect in here. And that's, you know, more my opinion. Fannie and Freddie say that's not true, but you can kind of see that in the data. So all of this data is where they make those determinations on the score of the appraisal, how good it is. But again, the score of the appraisal is based on all the data points. It's considered a quality appraisal with a good score if the data points match the computer model. It has nothing to do with the value. So in theory, it's not looking at the value when it's coming up with the score. So actually, before we move on to FHA, have any of you guys seen this before, or has any lender ever shown you? So this is going to be all your conventional loans. It's 60 to 70% of the loans in the country, depending upon your market. They are going through this. Again, every lender is using this on your. You guys are pretty familiar with DU findings or LPA findings, the automated underwriting system. It prints a score out on it. When we upload the appraisal to this, we get the score, again, anywhere from 1 to 5. So every lender is driving decisions off of this score. Again, anything that's 2.5 or less, we have rep and warrant relief, which protects us. So we, of course, want those lower scores. We can do loans on higher scores. Some lenders choose to do that. Some lenders don't. Some lenders will have an additional level of review, a desk review, or some kind of additional QC review for the higher scores. But that is based, this is what has been driving our market now for 4.5, 5 years for all lenders, where all the appraisals go through this. And this is the data that is determining, do we have a good appraisal or do we not? So this is, you know, changed the industry so significantly from when I got in it, when it used to be my knowledge of the market, the agent's knowledge of the market. Now it's what does the computer say? So we have some leeway, but not a lot, because if I have to argue with Fannie Mae about a loan, they say we have $1 trillion computer system and you're just a guy in Phoenix. So
You might as well give us access to that as listing agent.
it would be great. I mean, yeah, I argue this with Fannie Mae all the time. Like, if you already know the comps, why don't you just send those to the listing agents, and then we could solve like a lot of this. Exactly. So that would be great. So FHA appraisals, of course, FHA appraisals stick with the property. If you have an FHA buyer and there's already an FHA appraisal on there, the appraisal sticks with the property for 120 days. So lenders are required to cooperate with that transfer. So this is definitely something that affects listing agents. If you have a FHA buyer and the appraisal comes in low and that buyer falls out, and now there's a new FHA buyer, they get that same appraisal for 120 days. 120 days is crazy in this market because that could be a 50% change in sales price. It could be 100% change in sales price depending upon where you live. So FHA also has a portal. They call it the EAD portal. And that became mandatory in June of 2016. And so that's almost 5 years old now. This portal, all the FHA appraisals in the country are uploaded to it by every lender. Again, whether it's People's Mortgage or the Stagecoach Mortgage or the Spaceship Mortgage. And so one of the things with this is it cuts down on fraud. It cuts down on things like where the lender says there is no other appraisal on the property, but there actually was one. Now it's all tracked through the system. The EAD portal is also doing data edits to make sure the appraisal meets FHA guidelines. And so again, all these appraisals are in the system. They're all being evaluated electronically. When I got into the industry, I was a loan processor. It's kind of my entry level into the industry. We used to get appraisals. The appraiser would drive them to the office, and they had photographs that were taped to the appraisal, like actual photographs, which is kind of funny to me now. And my kids are like, what's a photograph? Like, if it's not on my iPad, they don't even know. But now appraisals really are all electronic. Like, we get them as a PDF, and you guys have probably seen them that way, but what they really are is what's called an XML format. It's all a data format that we're uploading to these portals. And all of that data is scrubbed by these different portals. And that is, again, kind of what is driving the whole appraisal industry now. It's all data, it's all data analytics. One of the things that's interesting, if you want to see just how much the industry has changed, if you go to Fannie Mae's website and you go to their career section where they have their job openings. So, Fannie Mae mortgage, they back the majority of the mortgages in the country. All of the jobs on their career section, they're all computer science and data analytics. There's no mortgage jobs, right? They're not looking for real estate agents. They're not looking for underwriters. They're not looking for processors. They're not looking for people who know about real estate or mortgages. All the jobs are data science and computer science, because that's the way it's going. So FHA also has this portal, and that is, again, been there since 2015. So they are also aggregating all of that data. VA, again, you can transfer cases between lenders. VA requires the lender to do what's called an NOV, the notice of value that we provide to the veteran. That does not transfer. And so this is something to keep in mind. VA is a little bit different than FHA. The appraisal may or may not stick with the property depending upon specific circumstances. But lenders are supposed to cooperate with each other. If a veteran is moving from one lender to another, you always want to do what is in the best interest of the veteran. VA uses an appraisal review process on every VA appraisal. It used to be CoreLogic, which we talked about earlier. VA they have Circular 26/2014, where they switched from CoreLogic to VeriScore. As a lender, I was super happy because the VeriScore cost is a lot less than the CoreLogic cost, so it saved me money. But again, this is one of those things where it scores the appraisal. So VA uses this on all their loans. You get your total risk score, a completeness score, a compliance score, a credibility score, et cetera. Then there's pages, it pulls comps as well that it thinks are the best comps. So VeriScore is a private company, but they are contracted with VA to do these reviews. So again, what I want to show you guys is kind of, as a lender, what we're dealing with is not the property, we're dealing with the data, if that makes sense. So as a buyer's agent, as a listing agent, and as a home buyer, your focus is on the property, the neighborhood, what does the seller want? What is the buyer willing to pay? But as lenders, we're looking at data. And that's because that's the way the industry has moved. The agencies, the GSEs, Fannie, Freddie, FHA, VA, they require us to do these quality control reviews. They require us to look at the data to make decisions based on the different data points that we get. Again, this is one of those hard things, right? Because when I first got in the industry, when I was underwriting loans before all of this, there was times where we would talk to the listing agent, like, how did you come up with the value? Where did you come up with these comps? Why do you think it is the way it is? Or the listing agent was picking the appraiser, so I didn't have to deal with any of that anyway. But even if I was underwriting the appraisal, you would use the value of the people who were involved in the transaction, right? Now it's, what does the data say? The interesting thing about appraisals, of course, is like, as a lender, if I have to foreclose on a property and we take it back and now I want to sell it, I don't get an appraisal to determine what I'm going to sell it for, right? I get a BPO, or I get with a good listing agent, and they tell me what to sell it for. So again, that's the whole thing, right? Appraisals are not the value of the home. Appraisals are the value of the collateral. So even as a lender, if I have a property I've taken back, I don't get an appraisal to determine my sales price. I go to a good listing agent and say, hey, I had to take this property back. I don't want it on my books more than 30 days. What price do I need to be at to get rid of this in 30 days? And an appraisal is never going to tell me that, right? That's what a good listing agent does. So the appraisal is data that tells us if we have good collateral, not the value of the home. So when we're in a market like this, like I said at the beginning, where supply and demand are out of whack, where it's a seller's market, the appraisals are always going to be behind that. And that's intentional because it's to protect the lender. And some of these things have been set so that we don't have the kind of housing bubble we had before. So if you think about what's going on when an appraisal comes in below the sales price, we as a lender are not allowed to base our loan on the higher of the two. We have to base our loan on the lower of the two. So if the sales price is 200 and the appraisal comes in at 180, then we have to base the loan on the 180. So every Fannie Mae, Freddie Mac, FHA, VA loan, the lender bases the value of the loan on the lower of the sales price or the appraised value. And what that means, of course, is the buyer has to pay the difference, right? So if we have a 10% down borrower and they have a $200,000 sales price, 10% down, their loan amount would be 180. But if the appraisal came in at 180, they would have to put down 10% from that 180. So they'd have to put down 18,000, but they still have to make up the difference because the seller wants the rest, the 180 to 200. So that buyer actually has to put $38,000 down when they were only expecting to put down 20,000. Well, if you think about that from a lender's point of view, that keeps housing bubbles from happening, because if the value declines, so if my appraisal came in at 180 and the sales price was 200, I'm basing my loan on 180. If home values declined 10%, that goes down to the 180, but that's where my loan started anyway. So the equity that was lost is the equity the homeowner put down, not the lender. And so a lot of these tools have been put in place to keep markets from crashing like they did in 2008. So I don't think any of us think home prices are going to decline anytime soon. But even if they did, the decline, the first piece of that decline is going to eat into the extra money the borrower put down, not the money the lender put down, which is what happened back in 2008. So a lot of these rules that have been put in place by the FHFA, by Fannie, by Freddie, by HUD, by VA, it is to protect the mortgage market and make sure that we are stable and healthy. Housing is important to the US. My personal opinion is that they use these systems to control prices and make borrowers pay more because it is better for the mortgage market. They claim they don't manipulate these systems. So you can believe that or not believe that. So yeah, I don't want to get too far into the weeds on that because I definitely don't. I see a lot of these though. I mean, I probably personally look at 300 to 400 appraisals a month. I'm involved in probably 12 to 14,000 loans a year in my role here. And so I see a lot, and it definitely, you can see trends, let's put it that way. But again, that's kind of why, I want to reiterate, like, this is how it works from the lender's point of view. Just so as a listing agent or a buyer's agent, you can kind of see what's happening when we get the appraisal. We're running them through these systems, we're getting these scores, we're making risk determinations based on that, where it used to be based on our knowledge, our experience, our expertise. So when we have property types, this is one of those things where people laugh at me here at work. Because they think like my tombstone is going to say there's no such thing as a townhome. In the mortgage world, there's no such thing as a townhome. So we have detached homes, which is typically single family. We have attached, which is not in an HOA. So sometimes those are called twin homes, Gemini homes, walk-ups. It depends what part of the country you're in. We have PUDs, planned unit developments that can be attached or detached. We have manufactured, we have condo, high-rise condo, detached condo, co-op. If you guys are in California, sometimes the co-ops are called OYO now. Co-ops have a bad reputation in some parts of the country, so they've been rebranded as OYO, own your own, but they're still co-ops. What we don't have is townhome. So for us, a townhome is either a PUD or a condo, and it will depend on the actual legal description. And I know listing agents have townhome as a choice when you are listing a property, and we have very different mortgage rules and a different appraisal form if it is a PUD or a condo. So if it is a PUD or a single family home, it's done on the 1004 appraisal form. If it is a condo, it's done on the 1073 appraisal form, and there are different requirements. So this is one of those things where our loan officers come in all the time and they say, hey, I have this townhome, can we make a loan on it? And then I say, we need to see the legal description, because I need to know, is this a actual condo or is it a PUD? And generally it depends on the state, but in most cases I can tell based on the legal description. And so there are very different guidelines for us to be able to lend on it. For example, in FHA, if the townhome is a PUD, I can lend on it, no problem. If the townhome is a condo, it has to be approved by FHA, and they have a website that lists all the approved condos. So there is no such thing as a townhome for us. It is going to either be a PUD or a condo, and it makes a big difference in borrower qualification and whether we can lend on it or not. So this is one of those things where, like, it's kind of my hill to die on. I wish that the NAR and MLS and the mortgage industry would come together and have the same property types. It would make it easier for all of us. Because I've dealt with listing agents a lot, and they're doing a great job. It's a choice for you. They list it as a townhome, borrower gets pre-approved as a PUD, appraisal comes in, or the appraiser says this is not a PUD, it's a condo, it's not FHA approved. Now my FHA approved way because it's not an FHA approved condo. And the agent says, well, it's a townhome. And I'm like, yes, but I don't have townhome as a choice. I only have PUD or condo. So it's one of those two. And I don't get to choose. The legal description tells me which one it is.
Is that really true?
So something to keep in mind there. For those of you guys in Arizona, co-ops aren't that common. I think we have 2 here. And other parts of the country, co-ops are much more common. Just one thing to point out there, if you ever do business in California, we're starting to see them called OYO, own your own, instead of co-ops, because some people don't like co-op, like it's a marketing thing. Same thing with, we have attached, what we call them is attached homes, but they're often called twin homes, Gemini homes. See those, a lot of those like in Sun City. You go back east, they're like brownstone walk-ups. Sun City is a little different because in most cases those are PUDs because there's an HOA, but that's different than a duplex, triplex, or fourplex because those are 2 separate homes. So anyways, if you take one thing away from today, there's no such thing as a townhome in the mortgage industry. And if you're a listing agent or if you're a buyer's agent, make sure the lender knows what it is and has pre-approved that borrower correctly. Because if they have pre-approved that borrower as a PUD, but it's really a condo, you could have significant problems. And you guys just, in your mind, it's just a townhome because that's a choice you guys have.
Good question. Do we have access to that FHA website to see if it's in?
Yes. So the FHA condo website is public record. It's available to listing agents, buying agents, borrowers. And so definitely, we can get that out to you. I definitely recommend that people check that out, especially if you're a buyer's agent. There's a lot of condo buying going on because of the price point, right? If you want like a 1,500 square foot home in Maricopa County, it's like $80 million now. So there's a lot of condo buying. If you're showing a buyer condo projects and the lender has said they're pre-approved FHA, definitely you should check the website to make sure you're only showing them FHA approved projects. That will save you a lot of hassle. As a lender, we do get that a lot where we have pre-approved the borrower for a FHA loan And now they've found a condo project that's not FHA approved, and there's nothing we can do. So that is a public website. VA also does condo loans only on VA approved condos. They also have an approval website. That is public record. So both of those are good tools. And if you're a listing agent, hopefully you're not accepting an FHA offer if your condo isn't FHA approved. Not all listing agents know that though. So I definitely recommend, if you're a listing agent listing a condo, that you know if it is approved or not. Same thing on manufactured homes. So manufactured homes, if you are accepting an FHA offer, they have to have a foundation that meets FHA requirements. You have to have an engineer go out and provide a certification. So that is something where, as a listing agent on a manufactured home, if you're gonna accept the FHA offer, make sure you have an engineer cert that meets FHA guidelines. They have to actually go look at the foundation. On conventional loans, so Fannie Freddie loans, manufactured homes, they don't automatically require an engineer cert. Fannie and Freddie only require an engineer cert if there's alterations or additions that affect the structural integrity of the manufactured unit. So that is something to keep in mind there as well. They're not automatically required. So some advice, most listing agents know this already, but if you don't, if you're going to list a manufactured home and accept an FHA offer, you want to make sure the foundation meets FHA guidelines. A lot of times they don't. So if they're newer, they typically do, but if they're older, they typically don't. And then detached condos. I know that sounds weird, but there's a lot of detached condos in Arizona. New construction, a lot of Lennar, Beazer, they all build these detached condos. They look like single family homes, but they zone them and plat them out as condos, primarily because it allows higher density. So they have smaller lots. In most of the cities, to be a PUD or a single family home, you have to have a certain lot size per square footage. You can sell that exact same model as a detached condo on a much smaller lot. The cool thing for us as a lender is we basically treat detached condos as single family homes. So for us, they're pretty good. And again, we're starting to see that more and more throughout the country with new construction, because it allows higher density building. A lot of people don't want a big yard anymore. So, you know, we've seen some of these homes, and it's funny because they'll sell the same model in different subdivisions. In one subdivision, as a single family home, you know, it's a 2,000 square foot home on an 8,000 square foot lot. And that exact same model is sold as a detached condo in a different subdivision, you know, a 2,000 square foot home on a 3,500 square foot lot. So, which is postage stamp, but if you don't want a yard, I mean, it's definitely, and it still can be, then you also aren't sharing a wall. So it depends how loud you like your music. A couple things we get on appraisals all the time, acreage or commercial use. So we get this question a lot. This property has excess acreage. It's a 50-acre property out in Cottonwood, or it's zoned for commercial use. Can we lend on it? So basically for all of these things, now again, there are lenders that have overlays. So I'm not speaking for all lenders. These are the guidelines directly. You may be working with a lender that has overlays. We don't run into this too much anymore, but in the old days, we used to run into the Countrywide. If you guys remember Countrywide Mortgage, they had a bunch of property overlays and people would quote that like the Bible. And I'm like, no, that was Countrywide, and they're no longer in existence. But anyways, what it comes down to is the appraiser has to say that residential use is highest and best use of the property. So if it's zoned for residential and commercial, the appraiser has to say the best use of this piece of property is for residential use. It is often true that the zoning is allowing residential use, but the property would be worth more if it was used as a business. And if it'd be worth more being used some other way, we are not allowed to lend on it. That is an appraiser's judgment. So there are times where we have gone back to them and said, why do you say commercial use is better than residential? But that is something that is always the case. We do a lot of lending in Nebraska, And so I'll give you an example. Like here in Arizona, you have 50 acres in Cottonwood. It's all that high desert scrub, right? It's totally fine. You have a nice house on it. Residential use is the highest and best use, no problem. 50 acres in Nebraska, they're gonna say highest and best use is agriculture because you have 50 acres, you should put corn on it. And so it isn't just about the acreage, right? It's about what is the highest and best use. And if here you can't do anything with that high desert scrub, 50 acres in Nebraska, you can grow corn and lettuce or whatever. We also look at the zoning. Is it legal? The zoning has to be legal. So there are people with illegal zoning. We can't lend on illegal zoning. We can do legal non-conforming, which is also known as grandfathered use. So a lot of times the zoning has changed and the property has been grandfathered in. The issue there is in most cases, the city has to agree if it burned completely to the ground that it can be rebuilt as is. So sometimes when the zoning is changed, they have different percentages that if it's a 50% loss, it can be rebuilt. But if it's a 75% loss, you have to comply with the new zoning. We can't lend on a grandfathered in property if in the event of a total loss, it can't be rebuilt the way we lent on it. So you'll see this definitely for those of you who are out in Gilbert. Gilbert, especially around downtown Gilbert, has rezoned a lot of that stuff. So there's a lot of old homes there that if they were burned completely to the ground could not be rebuilt the way they currently are. They would have to comply with the new zoning, so we can't lend on those. One thing that we run into a lot too is people question the land value. So they'll say they have a nice house up in Pine Top and you know, we're selling this home for $800,000 and the home is worth $200,000 and the land is worth $600,000. And so people get nervous about that. Some lenders won't lend if the land value is more than 50% of the total value, but that isn't actually the requirement. The requirement is that whatever the land value is has to be typical for the area. So if I have a home where the land is 75% of the value, I have to have comps that also have the land being 75% of the value. So as long as it's common for the area, there is no cutoff. This is something where a lot of lenders do have an overlay, but as long as it's typical for the area. I mean, if you think about like homes, you know, on the cliffs of Malibu, right? The value is all in the land, right? You know, you have a home on the Malibu cliffs that's worth $40 million. It probably costs $2 million to build the home, but $38 million is the beautiful view. Unless you are worried about climate change and then you have a whole other problem. If the property has agricultural use, it's almost always going to be ineligible. And so agricultural use means active farming. It doesn't mean I have a garden plot, you know, and I'm growing vegetables for my kitchen. It means active agricultural use. If they are farming it, it is almost always going to be ineligible. So something to keep in mind there. Properties with commercial modifications are also generally not okay. So there is a lot of loans, Fannie, Freddie, FHA, VA that allow mixed use. So I have a home and I run a daycare out of it. I have a home, I run a catering business out of it. Those are generally okay. What's not okay is if I pulled out a residential kitchen and installed a commercial kitchen, or if I have taken my living room and pulled it out and installed barber chairs, and now I'm running a hair salon out of my kitchen or out of my living room. Those are considered commercial modifications. So those things are things that we can't lend on. The main reason, if you think about it, right, if you're a lender, if you're Fannie or Freddie, if you have to take that loan back through a foreclosure, I don't want to have to find someone who wants to buy this house with a salon in the living room, right? The other thing I want to point out, which has become a bigger issue, it's not on the slide, but the thing that has become a really big issue is marijuana. So mortgage companies are federally regulated. We're regulated through the CFPB. We deal with Fannie and Freddie, which are GSEs. We deal with VA, FHA, USDA, which are federal agencies. Marijuana is illegal federally. So in most cases, if people have a grow room in their house, they are ineligible for financing, even if it's legal in the state. So there are a lot of restrictions for lending when the property is, or when the borrower is involved in the marijuana industry. And definitely if there's marijuana on the property. A lot of that's going to depend on the appraiser. Like, how am I going to know unless the appraiser is kind of a jerk and takes a picture of it? But something just to keep in mind, again, if you're a listing agent and you know they are growing marijuana on the property, that is probably going to be a problem, whether it's legal in the state or not. I don't know if that adds value or subtracts value from the house. I guess it depends on the buyer. So a couple things on the appraisal. Everybody, I think, has probably seen page 2 of the appraisal. Does it need repairs? As is means that's the value as the property is. Then you have subject to, which means there's repairs that need to be done. Subject to completion is usually for new construction. Subject to would be repairs. And then they write, see attached addendum, and there's addendum of all the required repairs. One thing I need to point out is a lot of people get stuck at the as is, and if the box is checked as is, they think the appraisal's fine. That just means this is the value as the property is. So everything has a value, right? The property could be currently on fire and it has a value. It's just not a very high value because it's on fire. That's where you need to go back to page 1 and look at other things, right? So like this property here, it has the boxes checked. Are there any physical deficiencies or adverse conditions? The appraiser has marked yes. This has basically exposed wiring and chipping paint. And if you guys don't know, apparently lead-based paint is like the most amazing thing you could ever eat. Lead-based paint, if you have a house that has prior to 1978, if there's any chipping or peeling paint, you have to get rid of it because lead paint is amazing tasting, and it makes you crazy, but apparently you can't stop eating it. So this is one of those things where this appraisal happens to be marked correctly, but a lot of appraisers will mark it as is and then also mark the physical condition problem that has to be remedied. And so people get tricked into thinking they're okay when they're not. There also is the general conformity one. So this has to be marked yes. So this first box should be marked no. The second box should be marked yes. And then you also have to look at page 2. So these are things that we're looking at as a lender. Are there repairs required? And I just caution you, because a lot of agents will call the loan officer and say, did the appraisal come in? They'll say yes. Did it come in value? They'll say yes. They'll say, did it come in as is? They'll say yes. And then they think they're done, but there still are repairs required. And so then they call, the loan officer says, hey, we need these repairs done. The agent says, you told me it was as is. The as is just means this is the value as it stands right now, but there's still health and safety issues that need to be repaired. So I would ask that separate question. The unfortunate thing is sometimes loan officers don't know about this. And so then that can be quite the problem. The other thing is the condition. So condition, this one says C4, condition is C1 through C6. C1, this is, if you guys are old like me, it used to be called good, average, below average, fair, poor. Now they just use C1 through C6. Most lenders will not lend on a C6, or you actually really can't lend on a C6. A lot of lenders won't lend on a C5 either. You really need it to be C1 through C4, and that's the condition. So, you know, it used to be, there was very subjective, so they made it numbers. So this is another thing to look at. You could have an as-is appraisal, but it could be in C6 condition, and then you can't lend on it. It could be in C5 condition, and you could be working with the lender who doesn't accept C5. So these are the things that, you know, we always tell people. I know as agents, you don't always see the appraisal, but these are good questions to ask if you're concerned about the property. These are things that can blow up the deal at the end. The last thing I'm going to cover here before I get into just some wrap-up market stuff. Everybody knows that there are minimum property requirements for FHA and VA loans. You know, all these things that have to be fixed, health and safety issues, the stairs are broken, things like that. One of the things I want to point out though is Fannie and Freddie also care about health and safety issues. I send this to agents all the time. This is a public record. Also, you can go on to Fannie Mae's website. Came out in December of 2018. Appraisal, frequently asked questions. What is the expected in regard to the appraiser's inspection of a property? So they are supposed to address health and safety issues even on conventional appraisals. That's basically the long and short of what this says. There's actually 2 questions on it. Here, the appraiser must identify physical deficiencies that could affect the safety, soundness, or structural integrity of the property. The reason I bring this up is we will have things where there are serious safety issues with the house, and the listing agent or the buyer's agent will call me and say, why are you guys requiring this to be repaired? The health and safety is only an FHA or VA thing. Fannie and Freddie do care. It is in their guidelines, and so I will send this to them. So they're less strict for sure, but I have seen properties where there are significantly known health and safety issues, like one where the floor was starting to fall through into the basement, and the listing agent said conventional offers only in the listing because they knew they couldn't pass a FHA or VA. Our loan officer took the deal, the borrower went under contract, appraisal comes back, appraiser says the subfloor is falling apart. Listing agent said health and safety doesn't matter to Fannie and Freddie, but it does. So this is in their guidelines. Again, they are not as strict. I'm not expecting you to think they are, but I do want to point out that you could get repairs on a conventional loan that you're not expecting, because Fannie and Freddie do have it in their published guidelines that the appraiser must identify those physical deficiencies.
It all has to come from the inspection?
Hopefully it's never coming from the home inspection. It's just coming from what the appraiser can visibly observe. My hope is the appraiser never sees the home inspection, because that can definitely adversely influence them. But they are supposed to look at what they can readily observe. So they're not expected to be experts in the mechanical systems of the home or test them, but if they notice things, they are supposed to call them out. We get this a lot with missing stair railings, where you'd be amazed how many people have 2-story homes and there's no railing, like you just fall down 20 feet, or a lot of people don't care. I was looking at one where they wanted it that way because they thought it had a better view. It was an open floor plan. So literally you go up the stairs and there's like a 18-foot drop and no railing. And I'm like, I drink a lot. I would not want to live in a house like that. On this health and safety thing, I had an appraiser call me, and he called me and said, I'm not completing this appraisal. And I said, okay. And he said, I'm going to send you some pictures and you'll see why I'm not appraising. I'm not going to complete the appraisal. So he sends me the pictures. I look at them, and there's a bunch of pictures of a bathroom. It looks like maybe a teenage girl's bathroom. There's a bunch of like hair and makeup products and stuff. Like, I don't know that much about hair stuff, but clearly someone's living there. And then the back wall of the bathroom is like this tackiest wallpaper you've ever seen, like black velvet wallpaper. And I called the appraiser. I'm like, this is weird, but like, I don't know why you didn't complete the appraisal. And he said, that is not wallpaper. That is floor to ceiling black mold.
Oh, what?
And you can smell it. And I did not want to breathe the air. And I'm like, wow, people are living in that house. So you'd be surprised what you can see. So that was a conventional appraisal. We were not going to lend on that property because it had floor to ceiling black mold in the bathroom, which actually is very terrible for you. If you don't know, you can die from that. So I feel bad for whoever was living in that bathroom. Reconsiderations of value quickly. This is where value comes in low. The agents want to dispute it. I do want to point out that FHA and conventional loans, there is no guideline for a reconsideration of value. There is no process built in. It assumes that the appraisal is what the appraisal is. We are allowed to do a quality control review, but there is no formally written process for an agent or a LO or a borrower to dispute the value. So we as lenders all have workarounds because we want to be partners with the real estate community. We want to provide the best options to our borrowers, but you cannot find a actual reconsideration of value process because it doesn't exist in that way. And so we all are trying to work around it, but I've shown you some of the technology that we see. That's why it's very hard for us to work around it, because we have to find ways to overcome the technology, but there isn't a formalized written process because it's assuming nobody knows the value better than the appraiser. So I'm not saying you guys agree with that. I'm just saying what the process is. VA does have a formal reconsideration of value process. It is called the Tidewater Act. Some of you guys are familiar with that. The appraiser, if the appraisal is going to come in low before they complete the appraisal, they reach out to whoever at the lender ordered the appraisal and they tell them, I am invoking Tidewater. You have 48 hours to get them the comps that the listing agent used to determine the sales price for them to revise the appraisal. If you are a buyer's agent or a listing agent and you have a VA offer, please talk to the loan officer and ask them what their Tidewater process is. If the loan officer does not know what you are talking about, that is a big red flag, because this is what happens in the worst case scenario. The appraiser notifies the person who ordered the appraisal. Very often it is a setup person, an appraisal desk person, or a loan processor. They get an email from that appraiser. That person does not look at that email for 6 hours. Then they email their loan officer and say, hey, Tidewater was invoked. The loan officer does not look at that till the next day. And then the loan officer emails the buyer's agent or the listing agent who's busy doing all of their agent stuff, and they don't get it, and the 48 hours have passed. And then the listing agent provides all of the information that would make the appraisal come in. After the 48 hours, the appraiser says, you missed the cutoff, too late. And now you still want to argue it, and VA says the appraiser invoked Tidewater, you ignored it, you're out of luck. So you want to make sure, if you are dealing with a VA loan, especially in this market where it's very likely the appraisal may come in low, that your loan officer understands the Tidewater process and will contact you. And if you get an email or a phone call from a loan officer that says Tidewater's been invoked, please respond fast. Because these appraisers, I'm not kidding you, man, they will cut you off. Some of them are nice and some will work with you, but a lot of them will not. So if you ever have a loan officer say Tidewater to you, please respond right away. It's in your benefit. But also you want to make sure that the loan officer has a good process so that it actually gets addressed. So that's what I have there. A couple things just to talk about again, appraisals coming in low. You know, of course, appraisers say the appraisal didn't come in low, the sales price was too high. For us as a lender, like, I don't care really, right? I mean, I want to have good collateral, but I also want the loan to close. So it doesn't do me any good for a deal to blow up, right? So I have both sides of that, because I only make money when the loan closes, but I want to make sure I have good collateral. So part of that is us working together. And so some of the things that we do, you know, is we prepare our borrowers. This is a seller's market. There's things where, you know, we have borrowers who they come in and they want to put 20% down, and we tell them only put 10% down because we think the appraisal is going to come in low. You use that extra down payment that you would have had towards the paying over the appraised value. And then that way, you know, we make up that appraisal gap. Often the best solution for us is a 15% down loan, because what happens at between 80 and 85% loan to value, we actually can sometimes get a price improvement because the loan has mortgage insurance, which is a compensating factor for the price. So one of the appraisal gap strategies that we have is to have the borrower put less money down officially for the loan, and then they have that extra money available so they can pay over appraised value. So that's one thing, especially for buyer's agents or listing agents looking at offers. Don't automatically assume that a 5% down offer is worse than a 20% down, because the loan officer may have told them, let's only qualify you for 5% down so you have this extra money to pay over appraised value. Because if they're only qualified at 20% down and the appraisal comes in low, they may not have the additional money to pay over appraised value. But if they're qualified at 5% down or 3% down and the appraisal comes in low, they may have that additional money in reserve. So typically you have a stronger offer, right, the more money they're putting down, but loan officers are trying to account for the appraisal gap. And the way you account for that is you qualify the borrower for a loan with less money down so that the extra money they have, they can use to pay over the appraised value. There's a whole separate discussion that we can have about why you should pay over appraised value in certain markets, but I definitely don't think it's automatically bad to pay over appraised value. Actually, I often think it's good, especially if you want to account for inflationary cycles and things like that. Being a homeowner is great in a inflationary cycle where inflation is going up, because the cost of money becomes less. So if you think about 10% inflation, it erodes the value of your money, but your home is increasing. If I take out a $400,000 mortgage today, but I'm paying it back with future money, if my money is 10% less in the future, then my mortgage is essentially 10% less, but my home is increasing. So there's a lot of reasons why you should pay over appraised value. Sometimes you don't have a choice anyway, but also, one of the strategies we use for borrowers with limited funds is we qualify them for loans with less of a down payment. So the money they would have used for the down payment, they're still going to end up using, but they're going to use that to pay over appraised value. So something to keep in mind, especially if you're working with a loan officer that you have a good relationship with, that you trust. They may tell you, this borrower has more money. The reason we've qualified them for a loan with less money down is so they have that extra money in reserve in case the appraisal comes in low. It's actually a good strategy that you can't always see with just offers that you guys are looking at. Does anybody have any questions? So we're right at
Kind of one real quick. As far as the data, I can't see the portal, how it could be real accurate in areas that they're flippers and investors.
Yeah.
We find that.
So for those of you who didn't hear, the question is about basically how accurate is the data in areas where there's a lot of flippers or investors. So the official answer is that the data is very accurate. My opinion is that the data keeps prices down in those areas on purpose. So that is where you are more likely in areas with a lot of flipping activity or a lot of institutional investors or private investors buying up properties. You tend to see worse scores on the appraisal, which means the appraiser either needs to get more conservative to get the score better, or there's additional layers of review. So again, Fannie and Freddie say 60% of the appraisals in the country score 2.5 or better, and that market activity doesn't impact that. I have not seen that to be true. I think that you see more scrutiny in markets where you have more flipping and more investment. So, you know, some of that is what they say based on what we experience, and that kind of is what it is. But it is, those are the tools that we are required to use. We do have to account for those scores. We have to account for that data. We have to justify it. That's kind of where that stuff comes from. So I appreciate all of your guys' time today. Hopefully you saw some stuff you'd never seen before. Hopefully you learned some things that you didn't know. And maybe if it saves you one deal this year, then I think it's time well spent. So I appreciate all of your guys' time. And thank you again for attending.